So, welcome everyone. I'm Alexander Mihalcea, and today we have one of the industry leaders, Alexander Mihalcea, founder of Archimax. Welcome, Alex. How are you doing today?
Very good. Thank you. Thanks for having me. And hello, everyone.
Awesome. And I'm excited to have you on the podcast today, and I'm sure you're going to be of great value for the audience. Now, before we dive in, could you give us a quick overview of what Archimax does?
Absolutely. Look, we're focused on the acquisition of small and medium-sized businesses, which is kind of a new and emerging asset class and investment strategy, which I'm looking forward to discussing more in detail with you all today.
Okay, that's really interesting. And you've got like a truly global life in career, starting in the US and moving to Belgium. We've then like spending 25 years in the UK. But for example, how have these experiences shaped your perspective on the investment part?
Sure. I grew up in the U.S., as you mentioned, and then eventually in Belgium, and then moved to the U.K. Oh gosh, it must have been in 2001. Started off my career in investment management and worked at various banks. And I guess I was focused at the time on running and managing fund of hedge funds, in particular in the Asia and emerging markets region. So a lot brought me to travel to all these different places and get a kind of a global perspective on a lot of things. And it was a very exciting time because it was at a time where the hedge fund industry in Asia was very nascent and very new. I think you had about maybe 200 hedge funds starting up at the time, and that were, following on from the success that you've had in the U.S. and in Europe. And so it was very early stage in that industry. And so we, as the largest investment fund in the region, it was a great time to be looking at this, understanding the space, and I would go out and meet hedge fund managers, understand their strategy, their asset classes, how they were running money and trying to generate returns, and essentially carrying out due diligence and monitoring these investments post investment, but also combining and doing asset allocation, portfolio construction, combining the different strategies to make a portfolio that had good risk adjusted returns. And that was an exciting time back in the day. And we, as I mentioned, we had the largest fund dedicated to the region in the industry. So we started off, it was a $300 million fund. By the time I left, it was $1.3 billion. So that really grew quite nicely and allowed me to get a lot of experience in that space. And then later in my career, I co-founded an asset management firm called Milltrust International, which still exists today, and it's very strong and continuing to do very well. It was an asset management firm based in London, Singapore, and Abu Dhabi. And the company runs various investment strategies for pension funds, family offices, and high net worth and the likes across a lot of different strategies. So we were involved in listed equities, fund of funds as well. That's on the public market side. We also had quite of exposure in real assets, so farmland investments in Australia and New Zealand. And we also have a venture capital program, which basically invested in early stage startups, in particular of the UK university ecosystem, deep technologies from agri-tech, food tech, life sciences, medical technology, clean tech, climate tech, really interesting businesses. And it's so I guess the perspectives I've learned from running and having the privilege of running these different portfolios of assets and asset classes have been quite enlightening. And so if you look at the hedge funds, obviously that you're building portfolios that are based on markets and sentiment, liquidity, risk management, hedging, and that's one typical characteristic of hedge funds. And then you have, on the other hand, real assets, which I mentioned, which were farmland investments in Australia and New Zealand. That was very much tangible assets, where you're banking on it's got inflation hedges and built in. It has you're buying land basically, so you're working on capital appreciation, and we had a buy and lease strategy, so we're getting income from the operators. And then I guess finally the venture capital space was, in that perspective, is more about betting on innovation and the real ambition of these new emerging founders who have come up with amazing technologies to have to deliver really impactful solutions for the world. And so that was a very exciting time. And I guess the caveat of venture is that a lot of these companies are at such early stages in most cases that they're still kind of proving themselves, trying to find product market fit. And so there's a bit of advisory that comes into that, helping these companies find the right trajectory for their growth. And so that's what I've been involved in.
Yeah, okay, that's really fascinating, and you have a lot of expertise in this field, right?
Well, yes.
But for example, I'm curious about this. So, what inspired you to transition from a high stakes world of hedge funds and venture capital to focus on, let's call, boring businesses?
Yeah, it's bit of a full transition. So look, I mean, I love venture. I love the early stage founders, the early stage technologies, and it's super exciting. And but the way venture capital is structured, and there definitely is a space for investors to invest in this asset class, but we think there's something else. And the issues that some people find with venture is that you're very much betting on binary kind of outcomes. You have a few outliers of companies that will make tremendous returns. The others will take a bit longer to materialize. And along the way, you have dilution, and so it comes with certain characteristics that that are not always favorable. And the fact that a lot of these startups, I think the statistics are that 80 to 90% of startups fail in the first 5 years. For me, having done venture capital investing for the past 15 years, I just realized at one point, well, the odds of finding the true unicorn are slim and against you. So there must be a different way to, maybe a complementary way to invest that minimizes some of these risks that are inherent with venture capital. And so, it really brought me to this, what we call kind of the wonderfully boring companies. And if you think about it, some of the largest fortunes in the world have been built upon boring companies and stability and resilience and things that are
Right.
just from every day. If you just look at Warren Buffett, he's made a whole portfolio and conglomerate based on that approach. So that's been very appealing to me. And so in kind of moving towards this kind of stability, I've also discovered this new investment strategy, which is called entrepreneurship through acquisition, ETA for short. And the whole concept there is really interesting in that you're not necessarily, contrary to venture, you're not trying to build something from zero and bring it from 0 to 1. The idea is you're an entrepreneur. You want to take on an existing business that's been around for 20, 30, whatever years, that's generating cash flows, that have existing product market fit, that have existing clients, and and are very profitable in their own right. And these are in the small sector side of the market. So we're not really competing with the private equity, which may be doing this kind of strategy in the larger end of the
Yeah,
market.
right.
There is a space here where it's exacerbated by the fact that you have all these baby boomer type generations who are approaching retirement age, and they haven't necessarily figured out their succession plan, and their children don't want to take these companies because it's not shiny and exciting enough, and so they're stuck with these companies that are perfectly great companies, and they want to retire, so they end up shutting down the doors, closing the doors, and leaving and closing it down, which is such a shame because it's a perfectly good, decent business. And so there's a whole opportunity for business buyers to come in, take it over, and then run the business and maybe do some value-added strategies on top of that. So that's something that really got me excited. And in this case, we're moving away from chasing unicorns to really trying to find workhorses.
Yeah.
Stability, basically. And so that's something that really got me excited. And I think in my stage in life, it's something that I'm looking for in particular, is like stability and predictability is something that really resonates. And so, again, there's a space for everyone. And if you like venture, then I certainly urge you to go and look at some of the great investment opportunities that we have at Milltrust, where I'm still a shareholder and on the board of the funds. But I think there's also an opportunity to look into diversifying into this other new asset class.
Right, 100%, yeah. But for example, what are the key characteristics of these boring or wonderful boring businesses that make them attractive as an investment?
Well, I think it's less so the intrinsic part of the business itself. It's more on the deal structure, if you think about it. It's the fact that you can buy these businesses in a creative way that includes vendor financing. You can have obviously the earnouts,
Yeah.
different payments, and then you take on some senior debt. And because these are cash flowing, businesses, you can pay down that through over time with the cash that the company is generating. So you can see it as a mortgage basically, and the more you pay down your debts, the more equity you end up owning. And so the returns have been really phenomenal in the asset class. In the U.S., it's been kind of tested and proven, and they're well more advanced than that. We can touch on that later, but the returns have been really phenomenal. And so that's what's gotten me really excited in that these companies are generating 20-30%, real cash returns, and they're stable. You can take them on, and you end up owning all the equity over a certain period of time. And so that's what we're doing in terms of like the companies we're looking at. They could be from anything from like pipe manufacturing, or it could be warehousing, logistics. It could be medical supply chains or whatever. These types of
Yeah,
things that are very
multiple.
much the core backbone of the economy, really, that are companies that are needed, that are resilient over when things are heading, if there's a recession or things like that. So that's what I think is quite attractive for these businesses.
Okay. And for example, also, could you explain the concept of boring investment club and how it helps investors to access their asset class?
Yeah, absolutely. Look, my background, when I left my firm to focus really on this asset class, my initial strategy was I was thinking of actually setting up a holding company, doing kind of a mini Warren Buffett, and buying a bunch of businesses. And I realized that actually I come more from the investment side of things, and I've have 25 years of experience managing money for institutional clients, family offices, high net worths. And so I thought, well, instead of buying businesses outright and then having to operate them, why don't I take kind of my playbook from my fund of hedge fund days, where I used to go and meet hedge fund managers. In this case, go and meet and find and identify business acquirers. And why don't we go and get them to run the businesses, which is what their expertise is, from an operational standpoint. And typically when these people go out and find businesses, they are sometimes in most cases they do need a bit of equity gap funding to help close the acquisition. And so that's where we can come in. We curate the deals, we find and then they come to us, and they show us the deal that they have, and we can then plug in whatever necessary capital they need and come in as an investor. And so the Boring Investment Club came from that basis that we would be backing these acquirers. And so I'm bringing in all my different network of professional and sophisticated investors. And by the way, Boring Investment Club is actually an acronym for buyouts of resilient income generating businesses. So it's a bit of a fun play on the words here. The private invitation only club, and what we do is we co-invest in specific SME acquisitions. We're not a blind pool. Everybody has a full discretion on their investment, but basically it's a club. So I would then bring the deal that I've identified, introduce it to the club members. We then look at it together, due diligence it, and then everybody makes their own decisions. It's structured as a bit of a crowdfunding vehicle. So we could put as little down as, I don't know, £10,000, for example, up to several million. And collectively, as long as we raise the capital that we need to plug in the gap, then we can move forward. I invest in every deal personally myself. And then when we've filled the round and with all the commitments, I will structure a special purpose vehicle in Luxembourg that combines and syndicates all the different investors into one vehicle that's tax efficient, tax transparent, tax neutral, and we come into the cap table as one investor. So the searcher likes that because they don't have to deal with a number of different investors, and it works for them quite nicely. And I represent and I kind of monitor the investment on behalf of my investors, and we report back to them and make sure that it's that the investment is progressing as it should. And so that's how it works. It allows. What's really interesting is that it's all deal by deal. So it allows investors to really build a customized and diversified portfolio of different deals that are backed by different buyers with different expertises, different sectors, different companies, different geographies. And so it's a nice way to do things and quite collegiate because everyone's kind of working together for the greater good of identifying whether or not it's a good investment to put money in.
Yeah, that's very impressive, unique approach as a company itself. But because you mentioned about the due diligence, for example, how do you identify and vet the proven operators who can take over these businesses and drive the growth?
Yeah, look, I mean, in there are finding them is just one part of the thing, origination. And there's a growing number of searchers in the UK and in Europe that I'm getting in contact with, word of mouth, but also there's websites, there's WhatsApp groups, there's LinkedIn obviously, and so the community is growing by the day. But then the real work starts, and I'm meeting these people at different stages of their journey. So some are just getting started looking for a business, some are kind of more advanced, having sent letters of intent to the vendors. Some are beyond that, and it's a long process. It typically takes 2 to 3 years to find a business, and if you think about it, these are essentially trying to convince the seller of the business who's been running it for the past 30, 40, whatever years, is their baby, right? So they don't want to hand it over to just anyone, and that's one of the concerns I had when I wanted to initially buy businesses. I thought, well, I'm coming from a finance background. I don't know necessarily how to operate a manufacturing business. So how am I going to convince someone to sell that company to me and that I'm going to do a good job at it? So this is why I kind of transitioned to the approach I'm doing it now. And so, yeah, it takes a long time to just meet the manager or the owner of the company, to convince them and to set up a deal structure that works for both parties. That's and finding the financing and all that. So that's the journey basically. And there's a lot of ups and downs, a lot of false hopes. In fact, most searches. It's very hard to buy a business. Actually, it's actually harder to buy a business than to sell a business, because a lot of these sellers are in two different minds. Again, I mentioned they've been running it for so many years, and it's something that's what are they going to do with themselves afterwards, right? So there is a distinction to be made between motivated sellers and those are kind of trying to understand what's happening. So anyway, the whole journey takes a long time. That's why we come in at the end stage when it's ready to go and pre-identified and due diligenced. And if you get back to your initial question, is how do we identify and vet these things? Well, bear in mind that through my fund of hedge fund days, we would do this whole full due diligence where we would analyze and do background checks on the company or on the acquirer, or in that case, the hedge fund manager. We'd analyze the company, see how that was structured. Then we'd look at the investments. And so it's very much taking that same playbook and same approach, but applying it to this space.
Yeah.
And so we've created what we think is quite an institutional grade due diligence framework, which in fact we call Best Fit. It's another acronym for, it covers basically the buyer, what his background is, his track record of building, operating businesses, managing teams, whether he's been a CEO in the past, whether he's bought businesses in the past, whether he's been able to scale and even exit businesses. So really looking at what their credibility is in taking over business like that. Enterprise is more kind of the operational due diligence, the financial due diligence, the legal due diligence, the commercial due diligence. A lot of that will be done by the searcher in conjunction with third-party accountants or legal professionals. So we typically get the full package in a data room, but then we apply our own kind of scrutiny and verifications, and we add and ask questions, things like that. So that's the best. And then the strategy is basically once the acquirer would take on the company, what's the strategy for driving growth and adding value to the company and taking it forward. T is for terms, which is kind of the terms of the deal that they've structured, the LOI, the terms that are for the acquisition. How is the financing mix done, and all that. And then feasibility is basically, we think it's basically testing the market assumptions that the acquirer has shared with us, validating a number of things, making sure that there's a fit between the buyer and the company itself, the team, the culture, that type of thing. And the last 2 points are more like investor safeguards, making sure that we're protected when we're investing. There's minority shareholder rights, there's reserve matters, there's voting rights, or whatever we want to put in there. And then finally, the trusteeship and how the governance post-acquisition would take place and how they would treat the shareholders and report back to them and things like that. So it's kind of like the full playbook. And so, yeah, look, it's certainly not all about spreadsheets and things. It's about the judgment, the integrity of the person, the temperament, the resilience, because they're going to go through a lot of ups and downs and managing the business. It's hard work. It's not as easy as a lot of people may say they are. And so today I've met maybe actually 83 different searchers who are at different stages of their process. Some we've turned down for various reasons. Some we're in deeper discussions with. Some we're just waiting for them to finalize the terms with the vendor and get over that line. And so, there'll be deals that we'll be proposing to the club on. We're looking to do one deal a quarter, but some might come. Sometimes we'll have 2 deals coming at the same time because it's not really in our control. But as long as it's a great deal, that's what matters. Quality is really key for us.
Okay, that's very interesting. But for example, because you mentioned this a little bit, for when you talk to potential clients, what's the biggest misconception they typically have about what you do?
Clients they're not really clients; they're more like co-investors, and I think for them, so they typically have exposure to private equity, venture capital, which they're all very familiar with, and they have exposure to equities, public market equities, maybe hedge funds, things like traditional asset classes. And so one of the misconceptions, I think, is that they assimilate small and medium-sized businesses, the risks that come with that, to equate the same type of risk as venture capital, which I would argue it's not the same risk, because these are companies that are already they're mature companies, but they just happen to be small businesses. And so it's a different characteristic and dynamic than you would have in venture capital. And so it is the same, it's very similar to private equity. But the thing is, the beauty with our model is that you can buy these companies at between 2 to 5 or 6 times EBITDA, for example. Whereas in private equity, you'd buy these at maybe double that price. And so that's not even bearing in mind technology investments where you'd have huge multiples. And so the price is very attractive. And and so that also helps to mitigate the risks of getting into this asset class. So I just think it's an asset class that is ripe for institutional or just more capital to come into these plays. It's a very human, people-driven asset class. In that, what I mentioned earlier, you have to speak to and convince the vendor to sell to you. Then you have to take over the company. You have to make sure that the staff are happy to work with you. There's a lot of different human elements to it, which is so it's less transactional. It's a real world, real life business with a lot of lives and careers at stake. So you want to make sure that it's done properly and with a lot of emotional intent, obviously. And so that's kind of a different approach to some of these other asset classes.
Okay, interesting like comparison here. But for example, this approach started in the US and it is like still early in the Europe. But what are the key differences between these two markets?
Well, I think, look, the whole concept of search funds is something that started at Stanford University. And it's now been around for the past 30 years in the US. And you've had tremendous returns. I think we're talking about 35% IR, 4 or 5 times return on investments over that kind of period. And so you have the whole asset class has become a lot more mature. They're teaching the class of ETA in Harvard and Stanford and things like that. So it's really, and now we're starting to see that in some of the universities here in Europe. And so, the whole, why I say it's different in the US, they're more advanced because they have more structures, they have more, brokers, it's just more organized. And you have a lot more people doing it. I think if you had something around 600 search funds doing this, and the concept of search funds is you typically raise a bit of money upfront to finance a 2-year search phase, and then you take that time to find the business that you want to acquire, and then after that you acquire the business and run it. We come in at the later stage. We decided to bypass the search phase itself because we want to do more deals more quickly and have more opportunities rather than wait for 2 years. That's just our own methodology. But the traditional search fund model is something that is quite established now, and we're seeing more in Europe doing this. In fact, Spain is probably the leader in Europe in this approach. Yeah, but then we're seeing, obviously the UK is becoming more mature, and then there's other places like in Germany, and so we're seeing more of these things happening. There's different bells and whistles to this approach. There's the search fund, there's a self-funded searcher that's not basically paying, they're paying for themselves for the whole search phase, and they're just doing it themselves. And then there's independent sponsors where you kind of package up and find the different operators, the business, and there's different ways of doing this. But and so in Europe, it's still, first of all, it's a very fragmented marketplace. You have all these different countries, different languages, different legal systems, different things. But I think that creates a lot of opportunity. And so you don't have the whole infrastructure that's only starting to be created now from like helping searchers find deals and packaging things up and organizing things. And you have the legals and, so it's still very opaque. And for me, it resembles very much the Asia hedge fund industry that I saw at the early stage of my career, where you had 200 Asian hedge funds back in the day. It was disorganized, it was messy, it was people were kind of starting things up in their spare bedroom and that type of thing. Now, and then it really skyrocketed from there, and you couldn't raise a fund in Asia if you didn't have at least 100 million or something under management with huge offices and all that stuff. So I don't think we're going to be there. It's a different asset class, but I'm just saying it's become a lot more mature, and I think here in Europe it's at the very early stages, and so I think we're about 10-15 years behind the US, and so there's a lot of opportunities and things to be done in doing so.
Okay, and on the flip side, what do you think are the biggest risks associated with the investing in these types of businesses, and how do you mitigate them?
Yeah, look, I think the risks are very much first of all, finding or choosing the wrong operator that doesn't have a good fit with the company that he's identified. On the company side, the biggest risk is founder risk, and so kind of the key man risk. If the founder owns all the relationships with the customers and it's been run kind of in that way, then if he leaves the company, then that's a big risk that has to be mitigated. In fact, if you talk to sell side or like people advising people who are looking to sell their businesses, one of the first things they say is, if you want to sell your business, go on holiday for 6 months, just to prove that the business runs by itself without your involvement. And so, that's something that has to be taken into consideration. Usually that's mitigated by, making sure that there's kind of second layers in the company that have those same relationships who've been running the business alongside the main founder, and basically that it could run by itself, or you keep the founder on as an advisor, or there's different ways of doing so, but you have to incentivize that person to stay on board or to help out if needed, and that's always a challenge. And so that's something you have to be very careful when you're buying the business. There's always execution risk that the operator has trouble integrating or executing and going and delivering the value that they want to do to grow the company if that's needed. But the baseline usually with these companies is that if you don't do anything, they typically, because they already have the clients, the customers, and all that they just continue to perform naturally as a nice baseline. But the idea is once they come in, there are small wins you could do to improve the growth of the company and to bring in maybe other verticals and things like that. You don't want to disrupt too much. In fact, on the buyer side, typically we say for the first 100 days, you go in, don't break anything, just stay there, don't do anything, just kind of observe, get the lay of the lands, make some small wins, win over the hearts and minds of the people that you're going to be working with. So it's all, that type of thing. And then I guess the other final risk, there's a lot of different risks, obviously, but liquidity risk, and you have to bear in mind that this is an asset class that is it's a private market. So, but whether or not you're going to be able to sell it later on depends on a lot of different things. And what we typically like to do, to the extent possible, is negotiate a contractual liquidity for our investors. So we tell the acquirer, look, we'll back you, but how about we have the option in 5 to 7 years, let's say, that if we want to get out, you buy us back our shares at this predetermined formula. It works for you because it doesn't mean you need to sell yourself the company or the shares if you want to hold on to it. But at least we have the option to get out if you want to do something else and if we need the money back or whatever. And so that kind of mitigates things from that standpoint. And then finally, I guess the mitigation is really making sure that you have proper investor safeguards and that you're monitoring and you've got good governance and maybe if it's a big enough company, board members, maybe, we could step in as board members as well and help construct the governance practices or and make sure they're enforced properly for the benefit of the shareholders, basically. So.
Okay, I see. And looking at the broader industry right now, what's your vision for the future of this asset class, and how do you see the Boring Investment Club evolving?
Well, I think this space is just on the cusp of exploding. From everyone I'm talking to, it's still very unknown, still relatively unknown. But it's in Europe, we're talking about. I just heard the other day that there are some people and some investment managers in the U.S. who are looking to put in $200 million next year into the UK, into this asset class, and invest in 60 search entrepreneurs. So we'll see if that happens. But it's just to show that the U.S. is already mature. They're coming over. We want to be positioned ahead of that curve. And so, we're building this Boring Investment Club. I think we're growing the membership every day. We're getting at the same time a huge amount of deal flow of entrepreneurs contacting us because they've got some deals that they are, they want to show us. So there's definitely a lot of interest. I'm getting a lot of interest from investors beyond Europe, from my connections in Asia and in the Middle East as well, and all that, who want to put money to work into this asset class. For them, it's great because we're here in Europe, we're covering the space quite well, and they're not on the ground, so they don't know what's going on. So for us, we can help them do due diligence, find the best deals, and it saves them a lot of time and trouble. And we're structuring it in a way that's deal by deal, so it's quite attractive. Is they keep discretion. So I'm seeing the whole asset class really expand into Europe. We're speaking to searchers all over from Eastern Europe to UK, Scandinavia, obviously Spain and all that. So in Italy as well. So it's going to be expanding quite nicely. And so from there onward, we'll see where it goes. But I think there's definitely opportunities. I've run institutional funds for the past 25 years in my career. Maybe there's a fund vehicle with discretionary capital that we can run for some investors that don't want to pick each deal by deal, and so maybe that's a way forward. There's other verticals and things that we can work on that we're excited about. But so I think I think institutional capital and more people are going to be looking to deploy into this asset class. So it's going to be becoming a lot more mainstream. And if it's anything, if the U.S. is any indication of how this space is going, well, I think there's tremendous returns to be made and opportunities. So we're very excited about the space.
Yeah, okay. But it sounds like you're ahead of the curve in many ways, which make me curious about your growth plans. So, for example, how are you looking to grow for the next year?
Well, at the moment, we are doing deal by deal. So we're growing. We've done one investment about a month and a half ago, oversubscribed by all the members. Everybody came back and said, we want to do more. So it was a good validation point. And I think, we'll do a few more of these deals, maybe once a quarter, one deal a quarter over the next, year. And then I think we'll grow with maybe launching a fund at some point and maybe working on that basis. So that's how we would grow the business.
Okay, I see. And before we wrap up, I'm curious about what's on the horizon. So when you look at Archimax's journey over the next few years, what possibilities excite you the most?
Well, it's still tying into a little bit what I just said. So I think the possibility is just being at the forefront of this move. I think there's a lot of opportunities. Maybe launch. I've just partnered up with a dear friend of mine who's launching a holding company in acquisition kind of roll up strategy in the agri-food sector, and so that's something we could naturally do more of and have kind of partnerships in different ways. So I'm sitting on the board of that roll-up strategy, advising them, helping them with the due diligence and research and acquisition of the businesses. And there's tremendous amount of opportunities in that space. Again, I did a lot of agri-tech back in the day, backing really crazy stories, which we can get into at the time. But now we're really focusing on just the production of food, which is everybody has to eat, right? And and there's this very fragmented. There's not a lot of people who want to work on farms these days anymore. So there's a lot of transition opportunities to be had and succession opportunities if you do this properly in some sort of roll up in clean environment technologies and that type of thing is something that's quite interesting to us.
Yeah, that's awesome. And for listeners who want to learn more or potentially work with Archimax, what's the best way to get in touch?
Yeah, well, look, I welcome all discussions, even just for informal chats. So you can reach me on LinkedIn. I'm on LinkedIn/IN/Alexander Kalis, Kalis, or on my website, which is www.archimax.solutions. So very much looking forward to hearing from you.
Perfect. Sounds great. And thank you for joining me today, Alexander, and for this amazing podcast session. And for anyone listening, make sure to check out Archimax socials below in the description, because this episode was packed with value and I can't wait to see what you build next.
Thank you very much, Alex. And I love being here, and thanks for having me.
Great. See you in the next episode then.
See you very much. Bye-bye.